watching Lunch Money this Monday afternoon. Domestic buying continues to see strong inflows, and we've seen mutual funds that are now looking at high traction as well. Morningstar has come up with a report on the best performing funds over the year. Let's in fact discuss some details on that with Dhaval Kapadia. He's the Director for Portfolio Strategist at Morningstar. Thank you very much for speaking to us. First question to you is, in fact, let's start talking about the fund flows just last year in comparison. Equities did very well last year, but the net inflow seems to have decreased slightly in FY17 versus FY16. Was it owing to the valuation concerns or external factors such as demonetization and perhaps others that you'd like to list?
Yeah, in fact, that's right. Maybe inflows last year into equities were slightly sort of lower than what you saw in the previous financial year. But if you add back inflows that have happened within equities, you've seen a bulk of inflows come into, or a large portion of inflows also come into ETFs. So you've seen essentially money coming in from EPFO to large cap ETFs. So if you add that portion to the money that's come into actively managed equity funds, I think then the inflow last year is pretty similar to what it was in the previous sort of financial year. So, and I think what one needs to see is, as a trend is, over the last 2-3 years, we've seen a substantial sort of rise in flows towards mutual funds, towards equity funds, vis-a-vis what we saw possibly 3-4 years ago, when we were seeing outflows from funds or very low flows. And the other positive development, I believe, that that we're seeing over the last couple of years is a sharp increase in the money that's coming through SIPs. So it's close to about 3,500 to 4,000 crores that is coming through SIPs every month over the last about year or 2 years or so. So I think that's a significant development. So I would say that it's although in terms of absolute numbers, maybe the flows, might be slightly lower than the previous year, but I think overall it's a positive trend that you're seeing.
Interesting.
And sort of just to add.
Yes. No, I just find it interesting that you're saying that a lot of the safe bets are kind of moving into equity, actively managed equity funds right now. But let's do a further split of that, Dhawan, because we're also seeing that there is so much more traction in the broader markets than in the frontliners, so to speak. So if you do a further split of where this money is going, the flow trends across categories, whether it's small caps or mid caps, large caps, where is the flow right now?
Sure. So I think the larger flow that we've seen last year has been in the large cap space, followed by small and mid caps, and then finally by the flexi-cap, which these are funds that invest both in large and mid cap kind of stocks. So a larger chunk of the flow has been going towards large cap over the last year. And in fact, if you combine, like I said earlier, that a good portion of the flows last year has come through ETFs as well. So which are essentially large cap ETFs. So if you combine that with the flows that have happened in large cap actively managed funds, I think that's a substantial chunk on the equity side. Another point to note, I think, would be also that within the equity space as such, we've seen a large allocation come into balanced funds. So this is a category, as you know, just to talk a little bit about balanced funds as a category, essentially these type of funds typically invest about 65 to 75% in stocks, and the remaining 30 to 35% in fixed income. So we've seen a substantial flow come into balanced funds last year. In fact, if you look at equity and balanced funds as a combined category, balanced funds are actually the largest recipient of flows last year. So about 30,000 crores of net inflows have come into balanced funds. And that's even larger than what's come into sort of large caps. So large caps would be about 11 to 12,000 crores. And if you add, the ETF flows into large caps, that would be about, 25 to 28,000 crores or so.
Okay, can I just ask you, in terms of those ideas on fund flows for FY18, how are you anticipating that, as well as what do you really believe any categories are that could really garner more fund flows in FY18 or could outperform? So, what are you sort of looking at quite carefully going forward for FY18?
See, very difficult to put specific numbers to the entire sort of analysis when you look ahead, because what's happened over the last couple of years, we've seen particularly over the last 1 year, we've seen a good run up in the markets. We've seen valuations also moving up as such. So therefore, I think there is a possibility that you could see a slight tempering of flows or a slight reduction in flows sort of going ahead. Having said that, I think what I mentioned earlier was also that over the last couple of years, we've seen a good build up in the SIP book. Essentially, money that's coming in, there's a steady flow of money coming in every month. So hopefully, I think that continues. But in terms of valuations, like I said, markets seem a bit stretched.
Yes,
so what
they
could
do.
possibly happen is you could see flows going into categories like balance funds.
Yes.
So you could see those kind of categories.
On that point, Dhaval, that you're making about balance funds, I just wanted to ask you about fixed income funds. They seem to have done very well in FY17 when you compare what fixed income funds have done in FY16, FY17, of course, getting supported by the bond rally that we've seen. We've seen the interest rate cuts come in. So all of this has helped its cause. So would you say that investors should continue to prefer them over fixed deposits in FY18, or do you believe that the best part of the rally is over now? This is again a little bit of a look ahead, considering what has happened in the past so far.
Yeah. So I think, fixed income funds, I think would tend to be sort of better bets for investors or better avenues for investors as compared to fixed deposits. So I think broadly speaking, because of sort of various benefits, including, you're investing in a diversified set of, bonds in across portfolios. I think another benefit of fixed income funds versus FDs is that in terms of taxation, they are much better off if you hold fixed income funds for at least 3 years. So from that point of view, I think fixed income funds would stand out versus FDs. Now coming to a point on, FY18, I think a bulk of the rally when it comes to particularly long duration funds. So these are essentially income funds or, gilt funds that invest in longer term sort of debt instruments. I think a bulk of that rally seems to be sort of done with. RBI in its recent 2 policies has indicated a shift to stance to neutral and so on. So therefore, possibly I think returns from longer duration funds should be sort of return expectation should be tempered down. And within the fixed income category, I believe that, possibly you could see more flows coming in towards short-term funds or credit opportunity funds, which are more sort of accrual based, which invest at the shorter end of the curve. And, there the return is more linked to the yields, on the underlying instruments. So net, I think, within the fixed income space, short-term funds and credit opportunity funds should possibly do slightly better than, longer-term income and gilt funds per se.
All right, Dhaval Kapadia, thank you very much for having joined us as the Director for Portfolio Strategies at Morningstar. Thank you very much for your take, as well as your the ideas you've given us in terms of how the fund flow charts are emerging there. Still ahead on the show, we're going to be discussing the RBI stance on the wholesale banks in detail with Hemant Kanoria of Shrey Infra. Please stay where you are.